Bob and Mary missed out on a $40,000 tax saving because they got financial advice after they sold the investment property. Don't let this be you. So they sold the investment property in June 2024. That's when the contract of exchange happened. But they didn't get the money until settlement, which was the next financial year in August. So they assumed they had time to plan, but they were wrong. Here's what they didn't know. So for capital gains tax purposes, when you're selling an investment property, the year that the capital gains tax happens is in the financial year that the property exchanges, not when the settlement happens, which is when you get the cash. Okay, so by the time they came to see me in August for financial advice, it was too late for us to make a tax deductible super contribution in the financial year that the property had settled, which was the previous financial year, because you can't backdate a super contribution. And because of that mistake, they lost, well, they paid an additional tax of $40,000 on the capital gain, which we would have significantly reduced had we been able to put some of that money into super as a tax deduction. So the tip is seek financial advice before you sell an asset. So before you sell an investment property or shares, make sure you seek financial advice, because there are some things that we can do to tax plan for you and sometimes for example, in Bob and Mary's case, we would have been able to reduce the capital gains tax payable on that property as well. So I'm Jenna Thompson. Feel free to book a 15-minute chat if you would like to learn more, and I'll be back with more money tips very soon. Bye.